Joining us now is Jed Dorsheimer. He's head of energy and power technologies at William Blair. Jed, it's great to have you. Can you give us the narrative? So what was your rating on the stock this year? Has it changed? Did you just upgrade it and now this is a downgrade? Just give us the backstory here.
No, we've had an outperform for a while on Tesla shares. And, we downgraded it, as Phil was talking about. We don't deny that investors want a CEO that's focused on the business, and Elon being one of the great innovators. However, there were knowns coming in the big, beautiful bill, such as the $7,500 tax credit that was going to be removed. What was less well understood was the fact that the CAFE emissions, those credits would be cut or effectively go to zero.
Oh, wow.
And that is a much bigger hit in terms of the margins. So that was $2.8 billion in 24. And so we believe that street estimates are about 400 basis points high on the margin as we look at street consensus, which means that, there's going to be multiple cuts.
Yeah. So 400 basis points, in other words, 4 percentage points. That's how much. Yeah, this has been a big part of their profit story for a long, long time, where these other companies paying them basically kind of help meet those credits. I didn't realize that goes
exactly
away. So let me ask it this way. You've actually been outperformed on the stock for a long time. Mm-hmm. It's been a controversial stock for a long time. So what was that previous optimism based on? And is whatever that was based on, is literally the bread and butter hit of losing those tax credits, whatever we're calling them, is that enough to derail even the big, massive stories like robo-taxi and all the rest of it?
Well, I don't think it derailed. It's really a question of patience. How much are you willing to, when we look at some of the parts, the auto business is a smaller percentage, even though it makes up a vast majority of the revenue and the current business. But, when you look at expectations, no one's buying Tesla for just the auto side of the business. You're looking at energy, you're looking at robo-taxi, you're looking at humanoid robots. And that those other further out opportunities are really where most of the value in the business is, which makes up a decent amount of the stock. So, when we look at this core business that's getting a hit, you're now again going back to investors and saying, hey, listen, focus on this thing that's out here that's going to come in 28. Don't focus on what's going to happen in 26, 27, in the back half of 25. And there's only so much that I think you can take. So that's really the reason that we're downgrading. And, we think that this is a momentum stock. And so if momentum changes and goes down, we'd rather look for better entry points at a lower level.
Do you think losing those, we'll call them the CAFE credits, does that actually literally impact their ability to invest in the future?
It's going to affect the cash flow of the business, certainly.
Yeah.
And so when you look at the combination of the $7,500, that just meant that the pricing of U.S. vehicles are going to get more expensive, or they're going to have to cut the pricing in order to keep that same level of demand, and that will cut into margins and affect cash flow. And then the tax credits going away in terms of the zero emission, that is a direct hit to cash flow.